Okay, I'm going to try to keep this video short, 5 or 10 minutes. Let's talk about risk management. So for you, Isaiah, this video is good for you, but anybody else that's going to watch the video, maybe come on as a trader, this is a TOS platform, desktop platform. It doesn't matter what platform you're using to make trade, guys and gals. It's not really the point of this video. Maybe we'll do a trade here in this video. But we're going to talk about really down and dirty risk management. And what we're going to talk about is margin. Now, what is margin? All brokers are going to require you to have what's called a good faith amount of money in your account to trade margin or to trade futures or anything that requires margin, okay? So lots of different types of trading require you to have a margin account, okay? And you have to have a good faith amount of money in that account. And that's called margin, okay? And if you don't have enough money in your account when you're making trades, the broker can execute or what's called a margin call. And that means they will liquidate everything in your account if necessary to get their money that you owe them. Okay? So let me give you an example. Right here in front of us is actually a live session. And this live session is on a paper trading account, so it's not real money. For new traders, you guys and gals would be trading with paper trading money, just like you see up here in the left-hand corner, simulated trading. Okay. And but we have a real live data feed going on right now on this particular futures. Upper left-hand corner, this is the E-mini light sweet crude oil futures. So we're trading oil futures. And let's talk about the risk management. It's /QM. E-mini light sweet crude oil futures. You look down here, upper left-hand corner, I'm on the screen now. You'll see a tick size, 0.025. You see a tick value of $12.50. And you see this initial margin, $2,351.80. That's the good faith part right there. The $2,351.80. That's what the broker expects you to have in your account, minimum, to trade one contract or one lot of this particular future. Okay? So if you make a trade and the trade goes bad, it goes against you, and all you have in your account is this exact amount of money, $2,351.80, the broker would immediately say, you're in risk of a margin call, because you don't have enough money to cover their requirement, their initial margin requirement, your good faith commitment to the broker, right? Your good faith amount of money to keep this account in good standing. So we would never trade in this case, a light sweet crude oil futures with only that kind of money in our account. We might have double that money in the account, minimum, maybe even more. Okay, $5,000, $6,000, $7,000. We're probably pretty safe for you to trade one contract. Okay. So I want to emphasize something here really important. We never, ever, ever want the broker to do a margin call or liquidate any of our assets in our account, whether that's stock or there's cash in there, whatever it is. We don't want them putting their hands on that and taking it because we made a really stupid mistake of not having enough money in the account to do trading in the first place, right? Never allow the broker to do a margin call on you. Do your math, get your spreadsheet out, take your time, learn it, whatever. Of course, we'll help you where we can, but a lot of it's going to be up to you to learn. We'll put out more videos to help you along the way, okay? So what am I really saying? To manage our risk properly, to trade this oil futures contract, we would want probably at least $5,000 in our account to trade it, because $2,300 is the minimum for one contract. So we want at least double. Okay. So let's take a look at over here to the right. We'll try to keep. I'm trying to keep this video short. We're coming up on 5 minutes. We might be a little bit more in 5 minutes, 10 minutes max. But this is live data coming across right here. Now it's a paper trading account. It's not real money. So we can do whatever we want here. Okay, but this is live data feed. Right now, E-mini oil contracts are being traded. This is live feed, real data. Okay, and it's at 45.80. That's where oil is today, 45.80. Over here, there's people, if you will, maybe not be people, could be just computers, but let's just call it people. 11 contracts are being asked at this price, 45.825. And only one is bidding. And it changed. It's going to change now. It's 11.6, okay? So that's the current price right there, 45.80. Now, if you look back over to the left here, we talked about that initial margin. You'll notice $12.50 for the tick value and 0.025 of the tick size. So what is a tick? A tick is every one of these lines. That's a tick, another tick, right? If you look at the difference between these two in value, it's 0.025, isn't it? 0.025 from, right, 45,900, if you will, 0.900 to 45.9925 is 0.025, isn't it? That's this tick value right over here. Now we're back on the left side of the screen, okay, right? 0.025. Now each time this moves up or down in any direction, that's $12.50 if you're only trading one contract. Okay? If it moves 2 ticks, that'd be $12.50 times 2 would be $25. All right? So I tell you what, let's try to place a trade here. It doesn't really matter. I would never haphazardly place a trade, but just for the sake of this video, I'm going to place a trade. I'm going to buy right here. So I just bought one contract. See up here it says +1. It's in green. Down here at the very bottom of the screen, you'll see it says +1. And the price I bought it at was $45,875. Okay. So now I'm going to go ahead and sell it. I just made $12.50. Okay. So there's commission involved, and the commission there probably ate up most of this trade, because normally I normally wouldn't just trade, buy in and get out in one tick later, okay? But that's just give you an example of how trading actually occurs, okay? So we would use H&J, the company I own. I'm a partner in the company. We have an algorithm, a mathematical set of rules that helps us trade, plus experience. You know, I'm an experienced trader, been doing it for a long time, maybe 30 years. So there's a lot that goes into learning trading, but you should at least in this video gotten the bare basic, bare bones risk management about margin. Okay. Again, just to recap, margin is a good faith amount of money that you have to have in your account based on their requirements that we already saw, right? To trade whatever you're desiring to trade, in this case, oil futures. Okay? And you cannot go below that amount. Okay? So we'll do another video where I'm going to show you how you make sure you never go below the amount of money that the broker is expecting to have in the account. Those are called stop orders. Limit orders are usually used to make profit, and stop orders, or also known as stop loss orders, are used to prevent you from blowing your account out, right? Or prevent you from having a margin call. All right. So very basic video talking about risk management. We saw one trade. Woohoo, I made $12.50, right? So take your time. Look at margin requirement. Go look it up. Google it, whatever your favorite search engine is. Okay. Look at it, margin requirement. Look at initial margin. Okay. And most of it you're going to see is going to be surrounding stock, but we're trading futures. Now we may trade some stock too, but the basic principle around risk management, or keeping your margin in alignment with what the broker's expecting, that's really important. Okay. Okay, that's it for now. We'll come back and do some more videos. We'll talk about risk management maybe a little bit more in depth. We might even do some trading. And we'll get into some other subject matters that are really important for new traders, okay? So that's it for now.